Okay, let's unpack this. You've given us quite a stack of sources here, and they promise to take us way beyond, the fries and burgers.
Right, into the actual mechanics of McDonald's.
Exactly. We're not really talking about just a restaurant chain today. We're diving into what makes this global giant tick as a sophisticated business machine.
That's the shift in focus these materials provide, isn't it?
Yeah.
This deep dive, and it's specifically for you, the listener who sent all this in, is really dedicated to understanding that economic engine, the one humming beneath those incredibly familiar golden arches.
Yeah, our mission here is kind of acting as your guides through this material. We want to pull out the absolute most important nuggets of knowledge.
Exploring its unique structure, maybe how it fends off competitors,
The financials that power it, and importantly, the real risks it faces. And just so we're clear, everything we talk about today, it's coming straight from the insights you've put right here in front of us.
Okay, so let's jump straight into maybe the most fundamental insight from these sources. The business model itself. It's framed less as a typical restaurant operator.
And more as something else entirely. This is where it gets really interesting, I think.
The core idea, and it's highlighted everywhere in your materials, is this landlord-franchisor engine.
Right, this dual model. It's brilliant, really. Combining traditional franchising, letting other people run the actual stores.
With significant real estate ownership. That's the kicker.
So 2 main revenue streams come out of this.
2 very powerful ones, yes. First, they collect fees from their franchisees. That's like the initial setup fee to get started.
Standard stuff.
And then ongoing royalties, usually a percentage of whatever that franchise sells.
Right, makes sense. But that second stream, the rental income, that's the game changer, isn't it?
Absolutely. McDonald's often owns the land, or at least controls the lease on prime spots, and then they lease that building back to the person running the restaurant.
So they're acting like a massive global real estate investor on top of everything else.
And the scale of this is just staggering. Based on the numbers you shared, like as of 2023, roughly 95% of their restaurants that's over 43,000 globally are franchised.
Wow, 95%.
Yeah. And that structure isn't an accident. It's the deliberate core of how they operate.
And the financial outcome of doing it this way is pretty dramatic, according to these sources.
It really is. For those franchise locations, the estimate is that McDonald's Corporation, the main company, keeps around 82% of the revenue they collect from rent and royalties.
82% just flows through as profit.
Pretty much,
Wow.
because their direct costs for running that specific unit are minimal, right?
Yeah.
They aren't paying the staff or buying the buns there.
Right, compared to the, small number of restaurants they operate themselves.
Exactly, where the profit margin is estimated way down, maybe only about 16%, because they're carrying all the overhead food, labor, electricity, everything.
You can really see the power of that franchise side in the numbers. 2023 revenue, something like $15.4 billion, just from the franchise places.
$15.4 billion.
Yeah.
It truly functions as a global royalty and rent collecting machine.
What's fascinating here, and the sources really emphasize this, is the kind of symbiotic relationship this creates.
Yeah, it's clever. The corporation handles the massive, capital-heavy stuff, finding and securing prime real estate all over the world.
Building that brand that everyone knows, spending billions on marketing, developing system-wide tech.
Stuff no single franchisee could ever dream of doing on their own.
Right. And meanwhile, the franchisee puts their own money on the line for the day-to-day, hiring the crew, buying the grills,
running the actual restaurant. And this setup pushes the operational complexity, the sort of daily grind and risk, out to those operators.
And because it's their capital invested, they're obviously highly motivated to make that specific location work.
But here's the loop, the sort of secret sauce maybe. Because the corporation's income, those royalties, is directly tied to how much the franchise sells.
And also tied to their ability to just pay the rent.
The corporation is fundamentally compelled to give them amazing support, great training, a solid supply chain, all that infrastructure.
So corporate helps the franchise succeed.
Which then directly feeds corporate's high-margin cash flow from rent and royalties. It's this self-reinforcing cycle. And that's what seems to give the model its incredible longevity.
The sources also talk about the model's simplicity. That seems key to its endurance, too.
Yeah, that's a good point. At its heart, it doesn't rely on, super complex, rapidly changing tech just to function. Its durability comes from meeting these really timeless human needs.
Convenience, speed, consistency, affordability.
Exactly. And as, the pace of life seems to speed up everywhere, the demand for that kind of offering arguably becomes even more baked in.
The value proposition is just incredibly clear. For us, the consumers, it's cheap, it's quick, it's consistent, you trust the brand.
And for the franchise, too. You get a turnkey business, basically. Training wheels, a powerful supply chain, a proven path. You're not inventing it from scratch.
And looking back at the history, which your sources outline, they've shown this consistent ability to adapt, haven't they?
They have. Adding things like salads, McCafe, trying out Big Plant, the big push into digital ordering, delivery.
These are all pretty significant adaptations.
Right, but they keep the brand relevant without fundamentally messing with that core economic engine. The landlord-franchisor structure remains intact.
Which suggests it might be pretty resilient for future changes, too.
That seems to be the argument. Okay, so they've built this incredibly powerful business structure. The next logical question is, how do they protect it? The sources bring up this idea of an economic moat.
Yeah, like a castle moat. What keeps the competition out?
Think of it as a competitive fortress, yeah.
Yeah.
Barriers that make it incredibly difficult for rivals to really challenge their position. And the materials you provided point to two main pillars holding up this moat.
Okay, what's the first one?
It's an intangible asset. The brand itself. Those golden arches. They aren't just recognized, they're like a global institution.
The sources mention it consistently ranks among the top 10 global brands, up there with like Apple and Google.
Right. And specifically within restaurants, a 2025 brand finance study mentioned in your materials puts McDonald's way ahead of everyone, even Starbucks.
Really? How much is the brand valued at?
Over $40 billion with this top-tier AAA plus rating. That kind of brand equity creates huge loyalty, but also just an instant mental shortcut for consumers. You know exactly what you're getting pretty much anywhere.
Okay, brand power. Huge intangible asset. What's the second pillar?
This one's about cost advantage, and it comes directly from their sheer scale.
We mentioned the numbers, 43,000 locations, 100-plus countries. That footprint is just unmatched.
And that scale gives them two massive cost benefits. First, think about their purchasing power. They buy so much stuff, beef, potatoes, paper cups. They can negotiate incredible terms with suppliers.
Terms that smaller chains just can't get.
No way. And second, their advertising efficiency is enormous. They spend billions on marketing, sure, but they spread that cost over such a vast amount of sales.
That the advertising cost per burger sold or whatever is incredibly low. They can just outspend and outmarket basically anyone.
Yeah. And your sources give a great example of how this moat works as an active defense, not just a passive one, especially when times get tough, like with inflation.
You mean with things like value promotions? The $5 meal deal or McValue type menus?
Exactly. McDonald's can strategically roll those out because their model can handle it. But think about a smaller competitor. They lack the scale, their margins are probably already thinner.
Because they face a terrible choice.
A really tough one. Either they keep their prices higher and probably lose customers to McDonald's value deals.
Or they try to match the prices and just destroy their own profitability.
Right. McDonald's moat, especially those high-margin rent and royalty streams, lets them use value like a weapon. A weapon rivals just can't sustainably match.
And importantly, the sources seem to indicate this moat isn't just sitting there, it's getting wider.
Yeah, they argue it's actively widening. A key driver mentioned is their strategy, accelerating the arches, particularly the focus on what they call the 4Ds.
Right, the 4Ds. Digital, delivery, drive-through, and development.
And the investment in digital, especially, seems to be creating this powerful new network effect.
Like the My McDonald's Rewards program. The numbers there are pretty big.
Huge. Over 175 million active users mentioned, generating something like $20 billion in annual sales just through the app and loyalty system in 2023.
Wow. That's more than just collect points, get free fries then.
Oh, definitely. It's a direct line to the customer. It's a data goldmine. It lets them personalize offers, push promotions, drive people back more often. It creates these stickier relationships.
And building a digital platform with that kind of scale, that many users, that's incredibly hard and expensive for smaller rivals to even attempt to copy.
Extremely difficult. And then you add their continued investment in tech, specifically for optimizing the drive-through and delivery.
Making those channels faster, more convenient.
More integrated into how people order food today. It just keeps widening the gap. It makes it harder and harder for smaller players to compete effectively on convenience, which is a huge part of McDonald's appeal.
Okay, so incredible business model, fortress-like defenses. But what about the human side? Your sources touch on something kind of surprising about customer satisfaction.
Yes, this is a fascinating paradox they highlight. Despite being everywhere, despite that incredibly strong brand, McDonald's consistently scores quite low in customer satisfaction surveys.
They mentioned the ACSI study, putting them near the bottom for like a decade.
Yeah, scoring a 71 in 2024, whereas a company like Chick-fil-A is up at 83. Big difference.
You'd think that would be absolutely crippling for a business that deals directly with millions of customers every day.
You would think.
Yeah.
But the argument presented in your sources is, well, that's not necessarily the fatal flaw, it seems. Because by and large, McDonald's customers aren't really looking for, traditional hospitality. They're not expecting to be delighted.
They're looking for utility.
Utility, exactly.
Yeah.
Speed, predictability, convenience, value. The relationship is mainly transactional, not deeply emotional for most people.
So even if surveys or social media show grumbling about like wrong orders or staff being maybe a bit curt,
which they do, there's also this massive amount of positive buzz around promotions or the brand's quirky persona, and just the sheer reliability of getting what you expect quickly and cheaply.
Okay, so the takeaway is customers kind of tolerate mediocre service because the core value, cheap, quick, consistent, convenient food from a trusted name is almost always delivered.
Their trust is in the predictability of that utility, not necessarily the service interaction itself. And that's actually a durable strength because they aren't dependent on delivering, 5-star service every single time.
Interesting. Okay, what about the other side of it, the human element, the employees?
Here, the picture is maybe less paradoxical, but still presents a challenge. It's described in the materials more as a frictional drag than a fundamental flaw in the business model. Well, employee sentiment seems lower compared to some peers. Like, only about 60% of employees reportedly recommend working there versus maybe 90% plus at places like In-N-Out, according to the sources.
And what are the main complaints?
Looking at reviews cited, you see common themes. Maybe disrespectful managers sometimes, feeling underpaid, sometimes toxic work environments in specific locations. Pay and benefits consistently seem to be the lowest rated aspects.
And the consequence of that is?
High turnover. Lots of new, inexperienced staff cycling through, which can lead to, slower service, more mistakes on orders.
Which feeds back into those lower customer satisfaction scores we just talked about.
Exactly. So it's like an operational headwind. It makes things less efficient. It doesn't help the brand perception at the counter level. But the sources argue it doesn't fundamentally threaten the core financial structure, that landlord-franchisor engine.
Right, it's a drag, but maybe not an anchor dragging the whole ship down. Okay, let's pivot then to the financial strength and the management steering the ship. Your sources call McDonald's an earnings machine.
They do. The current leadership gets highlighted, especially CEO Chris Kempczinski. The philosophy emphasized is very much about long-term thinking, acting like owners, and focusing on the health of what they call the three-legged stool.
The company, the franchisees, and the suppliers, keeping all three legs strong.
That's the idea. And his big strategic plan seems to be that accelerating the arches strategy, leveraging the core strengths marketing menu while really pouring investment into those 4Ds.
The language used sounds very focused, enduring profitable growth, phenomenal stewards of the brand.
And their approach to how they use their money capital allocation is consistently described as very rational and very much focused on shareholders.
What's the priority order?
Seems clear. First, reinvest in the core business, specifically to strengthen and widen that economic moat we talked about. Then, if there's cash left over, return it to the owners.
And we see that in the spending numbers cited. $2 billion in capital expenditures in 2024, planning for maybe $3 to $3.2 billion in 2025.
Right. And that money is primarily going towards building new stores and modernizing existing ones, all supporting that 4D strategy.
But they also seem disciplined about not spending on other things, like big acquisitions.
Very disciplined, according to these sources. They note a real aversion to risky empire building through M&A. They point to selling off Chipotle way back in 2006 as an example.
And since then, only minor tactical buys, like bringing the Israeli franchise business back under corporate control recently.
Exactly. The fact that their net acquisitions line item consistently shows cash outflow suggests they aren't spending big on buying other companies. They're sticking to their knitting.
And they are definitely serious about returning cash to shareholders.
Oh, yeah. Highlighted as a dividend aristocrat, that means they've increased their dividend payment every single year since 1976. That's a long track record.
Plus a huge share buyback program on top of that.
Massive. Returned $9.5 billion total to shareholders in 2024. and $6.9 billion of that was just through buying back their own stock.
So, this whole approach to capital reinvesting smartly, avoiding risky deals, returning excess cash, the sources say it passes the rationality test.
Absolutely. It suggests management is behaving like long-term owners focused on creating sustainable value, not just short-term gains.
Okay, back to this earnings machine idea. It's powered by that franchise and real estate model, right?
Yeah.
Generating huge, stable, predictable cash flows.
That's the core of it. And the profitability metrics cited are, frankly, exceptional for the industry. Operating margins consistently over 40%. They hit 46% in 2023.
46% operating margin. That's incredible.
It really is. And operating income itself has grown steadily from about $7.2 billion in 2020 up to $11.9 billion in 2024, based on these figures.
And what about the quality ratios? Things like return on invested capital.
ROIC is a great measure of how well they use their capital. And McDonald's ROIC is described as remarkably high. Yeah. Historically, kind of high teens, low 20%. The 5-year average mentioned is 18%.
Which is good, but how does it compare?
Well, the really striking number is the trailing 12-month ROIC, 23.3%. Compare that to the industry median, which is apparently around 6.2%.
Wow. So McDonald's is generating almost 4 times the return on its capital compared to the typical company in its sector?
That immense gap really shows the power of that asset-light, high-margin franchise model. It just converts capital into profit way more effectively than a traditional restaurant operator that owned everything.
And they're good at turning reported profit into actual cash, too. Free cash flow conversion.
Extremely good. They typically target around 90% conversion, meaning the net income on paper becomes real cash in the bank very efficiently. And that free cash flow has been robust and growing, hitting $7.3 billion in 2023.
What about debt? Do they carry much?
They do have debt, yes. Around 3.97 times total debt compared to their EBITDA in 2023. But your sources describe this as prudently managed.
Because the cash flows are so stable.
Exactly. For a business spitting out such reliable cash, that level of leverage is seen as quite manageable. And their interest coverage ratio, how easily they can pay the interest on that debt, is healthy, cited at 7.75 times.
Okay. So, summing up the financials. A resilient model generates tons of stable cash, very profitable, uses capital efficiently, managed rationally for the long term.
That's the picture painted by the financial analysis in these sources.
All right, so we've established it's a high-quality, financially strong business.
Yeah.
What does that mean for the stock price? Your sources looked at the valuation around mid-June 2025.
Right. And as you might expect for a business with these qualities, the valuation reflects that strength. It's not cheap.
Okay.
The price-to-earnings ratio, based on trailing earnings, is somewhere around 26.5 to 27.5 times.
And looking at cash flow measures.
Price to cash flow from operations is maybe around 22 times. If you use the stricter free cash flow measure after capital spending, it's higher, maybe in the 35 to 43 times range. Different ways to slice it.
Okay, and how do those numbers compare to McDonald's own history? Is it unusually expensive now, or?
It seems to be trading roughly in line with its 5-year average PE ratio, which is cited around 27.9 to 28.1 times. It's not wildly out of step with its recent past.
So what's the bottom line judgment from the source material on the price?
The conclusion is pretty clear. It's undoubtedly a wonderful company, no question about the quality. However, the current price doesn't look like a bargain.
Not a steal.
Not a steal. It's described more as a fair entry point if your goal is to own a high-quality, durable business for the long haul. The margin of safety here isn't coming from buying it cheap.
It's coming from the quality and resilience of the business itself.
Precisely. You're paying a fair price, arguably, for an exceptional asset, not getting it on sale.
Okay, fair enough. So if you own it or buy it at a fair price, where does future growth come from? It sounds like it's tied into that strategy we discussed.
Very much so. The primary engine for continued growth identified as the ongoing execution of that 4D strategy. And it's characterized not just as 4 items on a list, but as a powerful interconnected flywheel.
A flywheel. Explain that concept. How does it work?
It's the idea that these 4 things reinforce each other, creating momentum. So, digital engagement, the app, the rewards, captures data and drives repeat visits.
Right.
That data and digital connection then make delivery and drive-through operations smoother, faster, more personalized.
Okay, better convenience.
Which then drives customers to come back more often, maybe spend a bit more each time, boosting frequency and check size.
Which leads to overall sales growth.
Exactly. And that sales growth generates the strong cash flow needed for more development, building new restaurants, modernizing existing ones to better support digital, delivery, and drive-through.
Ah, I see. So digital boosts convenience, convenience boosts sales, sales fund expansion, expansion creates more points for digital interaction and convenience. It feeds itself.
It's a self-reinforcing loop.
Yeah.
And they're clearly leaning into the development part, with that goal mentioned of hitting 50,000 stores by the end of 2027. That's significant expansion, fueled by this flywheel concept.
Makes sense as an operational path forward. However, your sources also raise some serious flags, what they call permanent impairment risks.
Yes. These aren't just, temporary blips like a bad quarter or commodity price swings. These are potential structural threats that could fundamentally change the long-term story.
Okay, what's the first major risk they identify?
It's a big one, though maybe slow-moving. The broader societal shift towards health and wellness.
We've been hearing about this for years.
Decades, really. Constant public health messaging linking frequent fast food consumption, especially the core burgers, fries, sugary drinks, to negative health outcomes like obesity, diabetes, heart disease.
And while McDonald's has added salads and things,
Their core identity, and critically their core profitability, is still deeply tied to those traditional high-margin items. The risk is that a permanent accelerating shift by consumers away from those foods could erode McDonald's long-term relevance and, crucially, their pricing power.
okay, that's a plausible long-term societal headwind. What's the second risk? This one is described as being particularly novel, maybe even potent.
Yeah, this is the one that's really different. It's the potential disruption from GLP-1 drugs.
You mean like Ozempic, Wegovy, those appetite-suppressing weight loss drugs?
Exactly. The potential issue isn't just that people using them might eat less overall. It's that these drugs seem to fundamentally alter what people want to eat. They appear to reduce cravings specifically for snacks, sugary drinks, and large, high-fat meals.
Wow, so it hits right at the core of McDonald's menu, potentially.
It seems to target many of their most popular and profitable items. This isn't consumers choosing a healthier option. It's potentially a biological reduction in the desire for the very things McDonald's excels at selling.
That sounds unprecedented.
It really is. The sources cite analysts trying to quantify this, projecting a potential long-term drag on sales for companies like McDonald's, maybe anywhere from 1% up to 10%, depending on how widely these drugs are adopted.
And the adoption could be huge. Well, with the market for these drugs projected to maybe exceed $100 billion by the end of this decade, you could have tens of millions of people globally using them. It represents a truly unquantifiable structural threat to demand that McDonald's has never really faced before. A biological shift, not just a preference shift.
Okay, so that's a serious potential disruptor to watch. All right, let's try to pull this all together. We've got this detailed picture. Exceptional business, powerful model, strong moat, but facing some unique, maybe structural, long-term risks. How does the broader market seem to view all this compared to the analysis in your sources?
Well, the market consensus, as described in the materials you sent, seems kind of lukewarm, often reflected in hold readings from analysts. The market's focus appears heavily weighted towards near-term stuff, like the impact of inflation on their core lower-income customers, maybe some recent slowdowns in sales growth compared to the post-pandemic boom, geopolitical uncertainty affecting international markets. Wall Street seems mostly concerned with navigating the next few quarters. Okay. And the contrarian view, the one coming from this analysis.
It argues pretty strongly that the market is currently overweighting those temporary challenges.
And significantly underweighting the permanent structural strengths of the business. This analysis takes a much longer view, trying to look past the quarterly noise to those fundamental attributes that have driven success for decades. So the divergence is where the market sees maybe slowing same-store sales right now.
This analysis sees a global real estate and royalty empire that has consistently compounded value over time, where the market might focus on, say, the quality of the McRib or the service issues we talked about.
This analysis focuses on the enduring power of that underlying business model. The franchise structure, the real estate, the scale, the brand.
Exactly. The core argument is that the true durable value lies in that fortress-like system. Its ability to generate cash, its scale advantages, its widening digital moat. Assets that maybe the market takes for granted while it chases short-term trends.
Okay, let's crystallize the bull case then. Based purely on these sources, what are the compelling reasons to own McDonald's?
All right, bull case summary. You've got that superior high-margin royalty and real estate model at the core. You have an incredibly powerful and arguably widening economic moat built on that globally recognized brand, unmatched scale, and a growing digital ecosystem.
Plus rational management.
Rational, shareholder-friendly management with a proven track record of smart capital allocation.
Yeah.
And finally, a durable growth pathway forward through that self-reinforcing 4Ds flywheel.
Okay, sounds like a strong foundation. Now let's do the red team challenge. Let's flip the script. How could investing in McDonald's, based on everything we've just discussed, turn into a major mistake? Where's the potential for permanent damage?
Right. You have to invert the bull case. The most plausible path to really significant permanent damage, as outlined here, isn't that the brand suddenly vanishes overnight. It's more subtle. It's a systemic breakdown in the economics and the relationship with the franchisees.
Attacking the core model itself. How could that happen?
The scenario laid out involves a kind of perfect storm. Imagine persistent high inflation continuing to squeeze franchisee operating costs, labor, food, utilities.
Okay, higher costs for the operators.
Combined with something like widespread GLP-1 drug adoption, significantly cutting into demand for their core high-margin products.
So costs go up, demand goes down, a double whammy.
Exactly, creating a crushing squeeze on franchise cash flow, making it maybe difficult or even impossible for many of them to reinvest in their stores, pay their rent and royalties comfortably, maybe even stay solvent. Widespread distress across the system.
And how does that franchisee distress hurt the main corporation, McDonald's itself?
This is the critical link. If franchisees are under immense financial pressure, they're going to push back hard. They demand big concessions on rent, lower royalty rates. They'd resist corporate mandates for expensive store upgrades needed to stay competitive.
A franchise rebellion, almost.
Potentially. And if McDonald's corporate were forced to make massive concessions across thousands and thousands of locations just to keep the system from fraying or collapsing, well, that beautiful high-margin model we talked about, the 82% profit margin on franchise revenue,
It crumbles.
it crumbles, or at least significantly erodes. ROIC would plummet. The earnings machine would sputter.
So the market would suddenly stop seeing McDonald's as this pristine asset-light royalty collector.
And start seeing it as a business much more directly exposed to the messy, difficult, low-margin economics of actually running restaurants. Just like most of its competitors, it gets re-rated downwards.
So the failure mode isn't the brand dying, but maybe overestimating the financial invincibility of that core franchise relationship under extreme, unprecedented pressure.
That seems to be the key risk highlighted by the Red Team Challenge. It's about the potential brittleness of that crucial financial link in the chain.
Okay, so pulling all of this together now, for you, our listener, what this deep dive into your source material really seems to reveal is this fundamental tension. On one hand, you clearly have an exceptional business built on a really powerful, resilient model with a significant, arguably widening moat protecting it.
But on the other hand, it's facing some very specific, potentially structural, long-term risks, including one, the GLP-1s, that's truly novel and external, something it's never really had to navigate before.
It really makes you step back, doesn't it? Thinking about how this company, so familiar, almost deceptively simple on the surface, just burgers and fries, right, is actually built on this incredibly complex, interconnected, and very carefully managed business machine. Absolutely. And maybe it leaves us with a final thought, something for you to consider as you process all this information from your sources. Given that unique landlord-franchisor structure and this potential disruption from something totally external and, well, biological, like these GLP-1 drugs, is McDonald's actually less vulnerable because of its model, or could it be paradoxically more vulnerable to this changing world than its simple facade suggests? What really stands out to you from this analysis